everyone, and welcome back. We've been seeing the US dollar all over the news lately, and everyone's talking about how strong it is.
Yeah, it's been hard to miss.
But then you've got people like former President Trump saying, we actually need a weaker dollar. So
Yeah.
what's the deal with that? What's this whole overvalued dollar thing about? That's what we're going to try to figure out today.
Sounds good.
We'll look at why some people think the dollar needs to be adjusted and how that would affect all of us.
Okay, so at first glance, you might think a strong dollar is great for Americans.
Right.
I mean, we can get imported stuff cheaper and travel to other countries for less.
Yeah, it seems like a good deal.
But there's another side to this.
Okay, I'm listening.
Think about American companies that are trying to sell their products in other countries.
Oh, right. If their products are priced in dollars, then...
A strong dollar makes their stuff more expensive for people buying in other countries.
Like, say you're a company making some high-tech medical equipment here in the U.S. A strong dollar means hospitals and clinics in other countries have to pay more for it, right?
Yeah, and they might just go with a cheaper option from another country, even if the American product is better.
So our exports take a hit.
The sources we're looking at today really emphasize that point. One of them even uses the example of a country wanting to buy machinery made in America.
Okay, I'm following you.
If the dollar is strong, they might just go for something cheaper from somewhere else, even if the American machinery is better quality.
Yeah, that makes sense. It puts our exporters at a real disadvantage.
Exactly.
Okay, so a strong dollar isn't all it's cracked up to be. But wait, doesn't a strong dollar also give the U.S. a lot of power globally?
Oh, absolutely. The dollar's strength gives the U.S. some serious geopolitical leverage. One of the biggest tools we have is financial sanctions.
Right.
We saw this with the sanctions against Russia. Because so much global trade happens in U.S. dollars, we can basically cut people off from the global financial system.
Wow, that's pretty powerful.
It is.
But hold on. The International Monetary Fund, the IMF said the dollar is overvalued. How does that fit in?
Right. So the IMF estimates the dollar is overvalued by something like 10 to 20%.
Meaning what, exactly?
It means it's trading at a higher price than what you'd expect based on the U.S. economy's actual performance.
Oh, okay, I see. So, the economy might not be doing as well as the dollar's value suggests.
Exactly. Fundamentals, like a country's economic growth, inflation, and interest rates. Those are the things that should be driving the dollar's value.
So why is the dollar so in demand, even if it's maybe overpriced based on those fundamentals?
The dollar's in a unique position. You see, it's the world's main reserve currency.
Reserve currency.
I mean, central banks around the world hold a lot of U.S. dollars in their reserves. This goes back to the post-World War II era when the U.S. was the big economic power.
Okay, so everyone wants dollars because...
It's kind of a legacy thing, but it's important.
So is that reserve currency status what's pushing the dollar's value up? Even if that doesn't perfectly match how the U.S. economy is doing right now.
It's a huge factor. This constant demand for dollars keeps the price artificially high, you could say.
Yeah.
It creates a situation where even though the U.S. has had a big trade deficit for decades, the dollar hasn't weakened like you'd normally expect. And this is where former President Trump's ideas come in.
Right, because he really wanted a weaker dollar.
He did.
He talked a lot about wanting to make American manufacturing more competitive by making our exports cheaper.
Exactly. He also put pressure on the Federal Reserve to lower interest rates, which could weaken the currency. But the interesting thing is, some of his other economic policies might have actually worked against this goal.
Now, that's what I don't get. How could policies like tariffs, which he was really pushing, actually make the dollar stronger?
It's a chain reaction. Think of tariffs like taxes on imported goods.
Okay.
When you put a tariff on something, it makes it more expensive for businesses to import.
Right.
Then they pass that extra cost on to us, the consumers.
So prices go up, inflation happens.
Right. And to fight inflation, what does the Federal Reserve usually do?
They raise interest rates.
Exactly.
Higher interest rates in the U.S. make things like U.S. Treasury bonds more attractive to foreign investors who want better returns on their money.
So more demand for dollars.
And that pushes the value of the dollar up, making it stronger.
So Trump might have accidentally made the problem he was trying to fix even worse. Economics is complicated.
It really shows how everything's connected and how policies can have unintended consequences. Which brings us to the question. If a president actually wants to weaken the dollar, how do they do it? It can't be as easy as just printing more money, right?
I'd imagine not. There's got to be more to it than that. We'll get into that right after this break. So we're back, and the big question is, how can a president actually weaken the dollar? I'm guessing it's trickier than it sounds.
Oh, yeah. It's not as simple as just printing more money. The Federal Reserve's independence is a big factor here.
Okay, so the Fed's supposed to operate without political interference.
Right. Right. That way, it can make decisions based on what's best for the economy in the long run, not just for short-term political wins. Makes sense. So if a president tried to mess with the Fed's operations too much, wouldn't that make people lose confidence in the Fed? And maybe even in the dollar itself?
Exactly. It could really spook investors. They'd start to worry that interest rate decisions were being driven by politics instead of solid economic principles.
That sounds like a recipe for disaster.
It could lead to a lot of instability in the financial markets and erode trust in the U.S. dollar. So what could a president do if they want to try to lower the dollar's value? Well, there are a few ways they could go about it. One is by trying to influence the Federal Reserve to intervene in currency markets.
So the Fed would buy or sell large amounts of U.S. dollars to trade and change the exchange rate.
Exactly. Or they could lower interest rates, which we talked about earlier, to make the dollar less appealing to foreign investors. But like we said, this approach comes with risks.
Right, it could freak out the markets and make people think the Fed's not really independent anymore.
And that perceived lack of independence could make investors really nervous.
It's all about maintaining that delicate balance of trust in the system. It's like a house of cards.
It could raise concerns that interest rate decisions are being made for political reasons rather than being based on how healthy the economy actually is. This could lead to instability and ultimately damage confidence in the dollar. Okay, so let's look at another method: direct government intervention in the currency markets.
So in this case, the U.S. government, not the Fed, would step in and buy or sell dollars to try and manipulate its value.
That's it. But this also has challenges. It would require the government to spend huge amounts of money, probably by borrowing trillions of dollars, which could increase our national debt even more and potentially destabilize the whole financial system.
Sounds risky. So pressuring the Fed and direct government intervention both seem pretty dangerous. Are there any other options?
There is a third possibility: implementing capital controls.
Okay, what are those?
Capital controls are measures that restrict the flow of money in and out of a country.
So the U.S. government could limit how much foreign investors can buy in dollar-denominated assets like U.S. bonds.
Exactly. And possibly other assets, too. The idea is to reduce foreign demand for dollars, which could then make the dollar weaker, making American products more competitive on the global market.
I can see the logic there, but
Yeah.
doesn't that come with downsides too?
Oh, definitely. It could signal a move away from free market principles and make foreign investors hesitant to do business with the U.S. It might make them think twice.
Yeah, I can see how that might not be the most welcoming message to send to the global business world. It seems like it's a tightrope walk, trying to manage the dollar's value without scaring off investors or hurting the country's reputation in the global marketplace.
That's a great way to put it. While capital controls might weaken the dollar in the short term, there's a real risk of long-term damage to the dollar's position as a global reserve currency. And that brings us to the fourth and maybe the most interesting option: trying to get our major trading partners to agree to a coordinated devaluation of the dollar, like what happened with the Plaza Accord back in 1985.
The Plaza Accord. Now that sounds familiar. Can you remind us what that was all about and why it's relevant to our conversation?
Sure thing. Back in the mid-1980s, the U.S. dollar was much like it is today, very strong, and it was causing problems for American exporters.
Okay.
So to deal with this, the finance ministers of 5 major economies got together at the Plaza Hotel in New York City.
Who are the 5?
It was France, West Germany, Japan, the UK, and the U.S.
Got it.
Right.
So they wanted to work together to weaken the dollar.
Exactly. They wanted to bring it down to a more manageable level. They worked out an agreement, the Plaza Accord, to take coordinated action to weaken the dollar. It was a team effort.
Yep.
Each country agreed to do specific things to support the overall goal.
Can you give us some examples of what they agreed to do?
Absolutely.
Yeah.
For example, Japan and Germany agreed to boost their domestic demand by doing things like cutting taxes.
To encourage people to spend money in their own country.
Exactly. That way they'd buy less stuff from America, which had become expensive because of the strong dollar.
Clever. So what about the U.S.? What did we agree to do?
The U.S. agreed to cut government spending to try and slow down the economy. That would theoretically reduce demand for the dollar and lower its value.
Okay.
And all the countries involved agreed to intervene in currency markets.
Yeah.
They would sell large amounts of U.S. dollars to increase the supply and drive the price down.
So it was like a group project, a coordinated effort to change the direction of the dollar. And did it work?
It did. The dollar's value went down significantly in the years after the Plaza Accord. American exports became more competitive, and the U.S. trade deficit shrank.
So if it worked so well back then, why haven't we tried another Plaza Accord since? It seems like a logical solution if everyone's struggling with a strong dollar.
There are a few big reasons why doing another Plaza Accord today would be much harder. The economic and geopolitical landscape is totally different from what it was in 1985.
Can you give us an example?
Well, just think about how much more money is moving around in global markets today compared to back then.
Oh, yeah, that's true.
It's way more than it was in 1985, which makes it a lot harder to influence exchange rates through coordinated action. Plus, the U.S.'s relationship with its trading partners has changed a lot. Things are much more complex now.
Yes.
China's a good example. China's a major economic power now and a big competitor to the U.S. And though China also has concerns about the strong dollar, its economic interests aren't always the same as ours.
So we don't always agree on the best way to handle things.
Right. Reaching an agreement with a country like China to intervene in currency markets would be incredibly difficult.
So a new Plaza Accord isn't very likely. But let's say for the sake of argument that a president did manage to weaken the dollar. What would that mean for regular Americans? How would our lives change?
That's a really important question. And that's what we'll look at after the break.
Okay, so let's talk about what a weaker dollar would actually mean for us. What would change in our everyday lives?
One of the first things you'd probably notice is that imported goods would get more expensive.
Makes sense.
Think about all the stuff we buy from other countries. Electronics, clothes, coffee, even some of our food.
Oh yeah, hadn't thought about food.
A weaker dollar means all those things cost more for us.
So those deals we see on imported electronics wouldn't be so great anymore.
Right. And it's not just electronics. Food prices are really sensitive to changes in the dollar's value.
Maybe so.
We import a lot of our produce and other food items. So yeah, a weaker dollar could definitely make our grocery bills go up.
Ouch. That's something everyone would feel. It's not just some abstract economic thing. It hits us right in the wallet.
Exactly. It affects how far our paychecks can go. What about our savings? I bet a weaker dollar isn't good news there either.
Probably not. What happens?
Well, if the dollar weakens, the purchasing power of your savings goes down.
Meaning,
The money you've saved wouldn't buy as much as it used to.
it's like our savings are slowly shrinking.
You could say that. It's not as sudden as a stock market crash, but it gradually eats away at our financial security over time.
That's a good point. And what about traveling abroad? Would a weaker dollar affect that?
Definitely, Cole. Remember that European vacation we talked about?
Yeah.
Well, with a weaker dollar, your travel budget wouldn't get you as far. Everything would be more expensive. Hotels, meals, souvenirs, you name it.
So it sounds like a weaker dollar makes a lot of the things we enjoy less affordable. But we also talked about some potential benefits, right? Especially for American businesses.
Right. A weaker dollar can be good for American companies that sell their products to other countries.
How so?
Their goods become more competitive on the global market because they're cheaper for people buying in other currencies.
So they could sell more.
Yeah, which could lead to more jobs in manufacturing and other export-oriented industries.
So there's a trade-off here. A weaker dollar could help American businesses and create jobs, but it would also mean higher prices for consumers. Tough call.
It is. There's no easy answer. It really depends on a lot of different factors, both economic and political.
It seems like there are a lot of moving parts.
And ultimately, the decision of whether or not to try to weaken the dollar comes down to weighing the potential benefits against the potential downsides.
Well, we've covered a lot today, from how currency markets work to how changes in the dollar's value could affect our everyday lives.
We have. And I think this deep dive has really shown us that economic policies, even those focused on something as complex as the dollar, have very real consequences for all of us.
That's a great point. It reminds us to pay attention and stay informed about these issues because they really do shape the world we live in.
We do.
So as we wrap up today, we'll leave you with this thought. If weakening the dollar could potentially boost U.S. manufacturing and create jobs, but also lead to higher prices for consumers, is it a trade-off worth making? That's something for all of us to think about. Thanks for joining us on this deep dive into the world of the overvalued dollar.